How's it going out there? Welcome to Stock Talk with Mike. Today I want to talk about three of the US-based video game development companies: Activision Blizzard, Take-Two Interactive, and Electronic Arts. I'm going to do a bit of a side-by-side comparison of the three, looking at their financials, and talk a little bit about which ones I think could be a buy right now, and where they would fit overall potentially in your portfolio, and what some of the expectations might be. And while you're at it, it'd be great if you want to follow along by subscribing to my channel. And also, if you could like this video, that'd really help me out as well. So the video game industry as a whole saw just a phenomenal year last year in 2020, largely due to the pandemic. It hit over $180 billion globally in revenue, which was actually a massive milestone. You combine the global film industry, combine that with the North America sports industry, the video game industry is still larger than those two combined. Pretty crazy. If it just gives you some idea of the scope of the video game industry. This is their revenue growth over the past 15 years. And you can see they've just been kind of actually fairly slow and steady for the most part. The green here is Take-Two Interactive, which is the much smaller company, which in the last handful of years you've actually seen has actually probably had the largest uptick in revenues. Whereas the blue line is EA Sports, and it's been sort of like this slow, steady increase over the last 15 years or so. And Activision Blizzard is this orange line, and you can see back in 2008, I think it was, they had this big spike in revenue, and they had another one here in 2016. Those are actually due to two pretty significant acquisitions. When they bought Blizzard back in 2008, obviously that added to their revenue in a huge way. And then again in 2016, when they bought King Games, which is the mobile game component now of Activision Blizzard. And that gave them titles like Candy Crush, which significantly added to their revenue. Looking at the revenue growth of each of these companies over the last 5 years is when you really start to see some of the discrepancies. Starting with EA, Electronic Arts, they've only had about 29% revenue growth over the last 5 years, including a negative 4% year. Activision Blizzard has had about a 28% growth over the last 5 years in revenue, and that's even with the 25% revenue growth what we saw in 2020, and they had a minus 13% year in there as well. Take-Two Interactive, TTWO, is actually seeing the largest growth over the last 5 years with about 133% revenue growth. Let's compare some financials for the three. First, looking at market cap. But first I want to mention, you never want to compare companies' value based on share price. It has absolutely zero relevance as far as the value of the company, other than telling you if it's gone up or down in value compared to the day previous or something like that. Market cap is what you want to look at, and that's just taking the number of shares outstanding and multiplying it by the share price. And you can also see the market cap on most financial websites. So the market cap for Activision Blizzard is $79 billion. It's by far the largest. Take-Two Interactive, by far the smallest, only $24 billion, and EA Sports somewhere in the middle at $41 billion. So that's where you can get confused looking at share price, because Take-Two trades at a much higher share price than Activision Blizzard, but Activision is by far the largest company. Next, looking at PE ratio, forward PE. So that's just the price per share divided by earnings per share. And they all have a positive PE, so that tells you that they're profitable companies, which is great. And the forward PE is just looking at the price per share divided by next year's earnings. So that's what we're looking at here. That's what we care about. And they're actually, EA trades very cheap at 23.19 forward PE, which is a very good PE. And Activision Blizzard is just slightly higher, very similar, 24.78. And Take-Two Interactive does trade at a premium at 35.84, which might make some sense given its revenue growth history in recent years compared to Activision Blizzard and EA. Next, the PEG ratio, that's just taking the PE and dividing it by the earnings growth rates for the year. And anything below 2 is actually considered pretty good. And so this is factoring in their earnings growth rate, which is an important aspect as well. And Activision Blizzard has a pretty low PEG at 1.02. Take-Two a little higher at 1.99, and EA at 1.8. All pretty good though, but definitely the win goes there to Activision Blizzard. price to sales is something to look at, just really quickly looking at a company's financials, or definitely a way to look maybe at a company that isn't profitable at a quick glance at how expensive they're trading. And this is taking their market cap divided by total sales or revenue for the last 12 months. And Activision's trading at 9.7 times sales, Take-Two 7.1, and EA 7.3. So Take-Two takes the lead there. Revenue growth is very important to me, as I'm generally a growth investor. And Activision Blizzard just reported their Q4 results for the last quarter, and they reported 21.5% revenue growth, which was $2.4 billion in revenue. And EA also just reported, it was their Q3 for them, and it was about a 5% year-over-year revenue growth with $1.67 billion in revenue. And Take-Two hasn't yet reported. They actually report on Monday, but their guidance was for $0.81 billion in revenue. So substantially smaller, right? It's a smaller company, but that would actually be a decline of 12.9%. Of course, they haven't reported yet, and I really wouldn't be surprised if they beat, based on it being a pandemic year and how good their revenues have been lately. But even if they beat, I don't see it being anywhere near what Activision's was last quarter, because their guidance was for substantially lower revenue. For the full year 2020, Activision Blizzard reported 24.6% revenue growth, just over $8 billion in revenue. Again, Take-Two hasn't reported yet, but they're projected to have 6.5%, which would be $3.3 billion on the full year. And EA, it was actually their Q3 they just reported. They operate on a different fiscal, so their fiscal will end March 31st, but it's projected it'll be 1.1% revenue growth only for the full year, which would be $5.6 billion in revenue. So pretty low growth there. It's likely that Activision will take the full year revenue growth win. And for next year's guidance, Activision gave guidance for the full year of $8.45 billion in revenue, which would be just a 4.4% revenue growth. And Take-Two hasn't reported yet, so we don't have that guidance, but analysts are estimating just 5.2% revenue growth next year, which would be $3.46 billion. And for EA, they're estimating 6.3% revenue growth for $5.94 billion. So pretty mediocre revenue growth as far as guidance and analyst estimates for 2021. So that's a bit of a red flag for me. And I might speak to a little bit about the maturity of the industry and revenue slowing for some of these bigger players like Activision and EA in particular, that they've both recently, in recent months for EA and a bit longer for Activision Blizzard, they both announced dividends. So they have a small dividend payout of under 0.5%, but which, honestly, I don't get too excited about. I mean, a stock can move more than that in a day, right? So having a long time frame investing as a growth investor, I don't get too excited about 0.5% dividend. But I think they're still trying to, as they're mature and revenues maybe will slightly decrease, I think they're trying to continue to add value for shareholders. So I wouldn't be surprised, given that these are well-run, profitable companies, I wouldn't be surprised that dividend continues to increase as revenues increase slow. Looking at it purely from a financial perspective, I would give the nod to Activision Blizzard, but I also would be partial to Take-Two just based on their recent history of significant more revenue growth. EA, even though I think it's still a good company and I used to be a shareholder, I just have ongoing concerns about sort of the stagnation overall in their revenue growth. Another thing to compare here is looking at the 13F filings. So money managers that manage over $100 million in revenue required to report quarterly on their buys and sells. And you just tallying up the new positions and increased positions versus the closed and reduced positions. Activision has a net buy of 174 positions, and Take-Two only 4, and EA 119. So more money managers are buying all these stocks than selling, but the nod definitely goes to Activision Blizzard last quarter. Looking at analyst price targets, so using the rating scale of 1 being a strong buy, 2 buy, 3 neutral, and so on, Activision Blizzard has the highest rating of a 2.0 buy with an average price target of 100.79. which after the recent run up, last week after reporting earnings, that's actually minus 0.8% from current prices. So that's why sometimes you got to take these analysts' ratings with a grain of salt. They call it a buy, but their price target in the next year is actually down from current prices still. And Take-Two, a 2.2 buy, so slightly lower analyst rating, but with a target price of 201.79, which represents a minus 2.8% share price. And EA actually also has a buy of 2.2, but the target price is 156.32, which with the recent sell-off the end of last week after reporting earnings represents a 10.7% upside from from current prices. The short-term success of all these developer companies depend on their big franchise labels. For Activision Blizzard, it's Call of Duty, it's World of Warcraft, even Overwatch, and potentially remakes of Diablo, and even some of their mobile games like Candy Crush, which actually bring in a lot of revenue for them. And for Take-Two Interactive, Grand Theft Auto is just a huge driver for them, as well as names like Red Dead Redemption, obviously NBA 2K, and even Borderlands. And EA has their whole EA Sports lineup with FIFA, Madden, NHL, and Apex Legends. They even have Sims and Battlefield, and they have a number of other names, but some of these key franchise names are really the real growth driver. And that's a bit of a risk as well, because they're really dependent on rolling out big names and them being a hit. And I think something to watch, I put this graph up earlier as well, is that yes, the video game market is growing, but what you see happening, this light blue there, is the mobile game industry. And it's already grown to about 60% of the market, and that's continuing to grow and expand. And that will be 3/4 of the market in less than 10 years. So you've seen it with Take-Two recently acquiring a mobile game developer company, and Activision with King, that they're acquiring these mobile companies, trying to make sure they're heavily invested in mobile, as they will be a key revenue driver. Also, for all of these companies, subscription revenue and in-game purchasing will be a key revenue driver moving forward. But it's interesting, globally, the top 10 mobile game from a revenue perspective from December, and none of these are either of these three companies. So it's just looking at mobile, obviously. Tencent, the big Chinese conglomerate, has the top two with Honor of Kings and PUBG Mobile. So pretty interesting. I see Roblox on the list, which is interesting because that's sort of that game engine, not really a competitor with Unity, but it's same kind of idea. Casual developers can build games in it as well. And they're actually expected to IPO in 2021. And I think that'll be an interesting IPO. But yeah, basically on the top 10, there's none of these are on the list. The big risk there, they need to get some top 10, some big mobile games. EA looked like it was in some ways inexpensive and had the most upside from an analyst rating perspective, largely due to a sell-off. And that was after reporting earnings last week, which were pretty much in line with analyst estimates, just a slight beat on net bookings, 2.4 billion versus the 2.38 billion expected, and earnings per share of 3.06 versus the 2.95 expected. But it did sell off quite heavily on guidance as well, I think. And it did recover a little bit. But again, I'm just worried overall about EA's sort of lack of revenue growth in recent years, and if they can turn that around. And Activision reported revenue of 3.4 billion versus the 2.78 expected, and earnings per share of 1.21 versus the 1.17 expected. And they gave some pretty good guidance for at least the first quarter. I know I mentioned for the full year it wasn't that great looking, but it was better than what analysts expected for the first quarter. So they saw quite the spike. They mentioned Take-Two is going to report earnings on Monday, so it'll be interesting to see what happens there. They have been on quite a run. This is the 1-year chart, and it's been kind of straight up. So I think there's expectations will be running high. Just looking at the three of them, comparing over a 5-year chart, Take-Two is the clear leader, And, it is a smaller company by far than, say, Activision Blizzard and even EA. So it kind of makes some sense as well from that perspective. And they've had some big names, obviously, with Red Dead and obviously Grand Theft Auto, some of the biggest franchises in the industry. And they've returned 521% over the last 5 years versus Activision 203% and EA 149%. But I mean, past performance is obviously not an indicator of future performance, but obviously with that, Take-Two, not only share price, but they've just seen the most revenue growth over the last 5 years. So I like that from Take-Two. So the bottom line, Electronic Arts does trade cheap, but for me personally, I don't like to trade or sacrifice revenue growth for value. And I have ongoing concerns about the lack of revenue growth in recent quarters. But I do like Activision Blizzard and Take-Two for their growth prospects, their product lineup, and especially Activision for its valuation. Activision and Take-Two, it's like blue chip companies now. Like, they're profitable, they've got a good balance sheet, they are growing revenues. And again, they can vary a bit year to year and it creates buying opportunities. But in the long run, I think you'll be just fine with either of these companies. There's very little massive downside risk. Like, obviously they can sell off if they miss a number or whatnot. But I think they're going to give you nice, steady returns over the long term. It's just, I don't think those massive outsized returns are in the cards for the next decade. In this environment we find ourselves in with a lot of very expensive, unprofitable companies, you actually can find some value with a little bit of growth in these. So I do like these names from that perspective, just from a portfolio diversification perspective as well. And they will benefit from the continued growth of the gaming industry as a whole. Anyways, that's all I have for you today. Thanks for watching. Happy investing.